Let's talk about the President Buhari's administration, which has kicked off a tighter tax regime in the new year 2022 by introducing 6% tax on digital services, while sugar tax is now levied on all non-alcoholic and carbonated beverages. And there is more in President Buhari's government tax playbook for you in the new year. So let's digest some of this as now turn to my guest, Yomi Olugbero, partner and West Africa tax lead at Deloitte, Nigeria. Yomi, good evening. It's good to have you here in the new year. This is the man I fondly refer to as the tax oracle.
Good evening and happy new year.
Great to have you.
Good to see you.
Great to have you. Thank you so much. Let's hit the ground running because these tax issues are getting a bit, sometimes you see the front pages of newspapers and folks could get really scared. So what are the tax issues that are related to the Finance Act and in the budget to start with?
Yeah, so I mean, we had the benefit of having the third consecutive Finance Act. You remember that we had it first introduced in 2019 with the Finance Act of 2019, then we had it in 2020. And when the president was signing the appropriation bill into law, just on the eve of the new year, we have the Finance Act for 2021 also signed. Essentially, I think the Finance Act is just building on some of the progress or successes that we've had in the last 2 years, because government has been focused on how do we grow the non-oil tax revenue.
Have we had successes in the last 2 years?
I think we've had success. If you look at the headlines today, you will have seen how much FRS, for example, raked in revenue. About 6.4 trillion naira, the record said. That's going to be the record highest so far. And it's coming on the back of some of the changes that were introduced. You remember we raised the tax rate, VAT rate, from 5 to 7.5% through this instrumentality of Finance Act also. Digital services player, were brought in with a significant economic presence, and some of the tweaks, that we make. So even though there haven't been too many new taxes or so much of raising of the increases, but the whole essence of changing the law is to ensure that where there are loopholes, you block them. Where there are leakages, you try to ensure that the rules are a lot more clearer so that the taxing authorities can chase taxpayer more effectively.
So in a manner of speaking, there are not really new taxes. For example, you look at a very long list. We have tertiary education tax, capital gain tax, and all of that. It's like dusting them up. That's what the finance minister is doing and his team.
That's what technically speaking. So the Finance Act made amendment to virtually all tax legislation that we have in the country. There are 13 different laws that were amended. I think the only two in my head that were not touched were just the recently passed regulations like the Company Act. That's not a tax law, but you know that the Company Act also has some connectivity with how businesses are taxed, and also the Petroleum Act, Petroleum Profit Tax Act, which just got amended. PPT, but every other tax legislation, from Companies Income Tax Act to Customs Act to Education Tax Act to VAT to FRS establishment, about 13 of them were touched. Now, there isn't so much of big headlines in terms of new taxes coming in or being raised. However, the impact or the implication of amendment is that it's either going to lead to increasing your taxes or reducing your taxes. And we have quite a few of them that kind of sink into the way you put the headline, because what the government is doing is actually tightening the rules and making enforcement, mechanics to be a lot more easier for the revenue authorities to chase. And some of them obviously are likely going to lead into increases in taxes.
Quickly on the how should the businesses or the corporates environment prepare for the tax regime in the new year? What will affect them? There's a sugar tax law. I don't know if some of us can get well, if you get to this age level, you begin to say, well, goodbye to carbonated drinks. But again, there's just a sugar tax here and a few other corporate capital gains tax, there are a few other tax for small firms as well. So how will the business environment in 2022 be impacted?
Well, I think the first thing is for business community to actually get acquainted with the changes that has happened. A lot of changes has happened, some very fundamental, some just tweaks here and there. Like you did say, the excise duty regime, for example, we used to have excise duty on non-alcoholic beverages and tobacco. Now we've had it expanded to non-alcoholic beverages as well, all those sweetened drinks. That's why they are called sugar tax. It's not necessarily that you have the word sugar tax there. You have tertiary education tax, for example, raised from 2% to 2.5%. And I mean, we're on a rights exchange. We also have the introduction of the capital gains tax to disposal of shares. I mean, for me, that's probably one of the major changes that is happening within the tax space. So prior to now, when you have share deals, when you dispose of your shares and you make capital gain, as an attempt to deepen the capital market activity, government says there wouldn't be tax on gains made on disposal of shares. That's what we had up until 31st of December 2021. Yes. But now, the new law made amendment to the Capital Gains Tax Act, which now introduce or include gains made on disposal of shares as being liable to capital gains tax at 10%. Perhaps the only comfort is that the retail capital gains tax transaction are still excluded. So you need to have large transaction of 100 million naira and above to be liable to such tax. So it's for big transactions.
For folks like you.
For guys that come on your show. Except for tax guys.
Who makes 100 million transaction? Who makes 100 million transaction? Maybe Aliko and the rest of them in a single transaction deal. But again, these are very interesting. The implications is what I'm looking at of this tax environment on our quest for both capital and overseas investments. Do you think this new tax regime, the widening of the net, the tweaking of the rules of engagement and all of that would have some bite on that?
Yeah, I think maybe the first point is that this happens everywhere in the world. You have every jurisdiction trying to make amendment and try to make changes and all of that. So changes itself shouldn't necessarily drive direct investment away from the country. But what I think we need to do slightly more is to be a lot more cautious in some of the choices we make with respect to the changes we make in our tax law. So, for example, the international tax regime, like the regime for digital services player, looks like Nigeria is taking a unilateral action, which is quite different from the direction that OECD and the rest of the world is facing. Because Nigeria has evaluated
the global tax, which came into
with the global tax
regime.
Absolutely. So Nigeria did evaluate its circumstances and it's like, look, we're not going to benefit substantially if we toe the line that the rest of the world is towing. And that's why the significant economic presence law was retained. And now the rule is even clearer. The government now says is 6% of your turnover. So it's not necessarily a new tax because prior to now, all digital services players are already liable to tax if you have 25 million naira revenue in Nigeria. But what the law had now done in 2021 Finance Act is to determine what will be the rate or what will be the basis for subjecting your revenue in Nigeria to tax. We used to have this old turnover basis where 20% of your revenue is seen to be your taxable profit and you tax that at 30%. So that's essentially what is mirroring the 6% tax on digital services player that you have.
The business sector, I'm with the organized private sector and others because that's all. Because now they're going to pay tertiary education tax, they're going to pay National Agency for Science and Engineering Infrastructure. Small firms turnover of less than 25 million will have losses to claim capital allowances for capex and all of that. Don't you think the organized private sector will complain? Well, is there a reason for some complaint?
Every time you make changes that will, increase the tax burden or pressure, you're likely going to have feedback from the business community, and there are valid reasons to do that. Not so much because of the changes, but I guess there will be ask for why don't we also deal with some of the impediment that we have spoken about a number of times, particularly the multiplicity of taxes. For example, we haven't done so much try to consolidate the number of taxes because in terms of the headline rate, if we're going to be very sincere, our rates still appear to be competitive. 7.5 VAT rate is still perhaps one of the lowest even on the continent. Right. But
some are doing 14.
Some are doing 15, some are doing 17 and a half. Yes. But we have several other levies and charges that we haven't done so much about. We also have multiplicity of revenue collecting agencies, including, you have customs, you have FIRS, you have NPA, you have NIMASA, you have, different state tax authorities, making claim, even law enforcement agencies, we have RAMFAC, and all of that create this multiplicity of agencies you have to deal with. There was an attempt, in this Finance Act to re-establish the supremacy of FIRS as the sole tax collecting agent for the federal government, but we still have several laws that still needs to be repealed to make sure that we
centralize. 2021 hasn't really been resolved. But we're going to go back to the sugar tax, because the last time I had something sweet in, I don't want to mention brand names, but it's still sweet. I'm not sure if this is going to be sweet for Nigerians who will be thinking of whether the price of carbonated drinks and non-alcoholic drinks will have to go up, because there's now, I don't know whether this 10 naira per liter, I don't know how it's going to be calculated, but you tell me about that when we return. This is your section. You'll be right back with Yomi Olugbenro of Deloitte, Nigeria. Welcome back, everyone, to my discuss on Nigeria's tax playbook with Yomi Olugbenro, partner and head of West Africa Tax Matters at Deloitte, Nigeria. Yomi, thank you very much. What's in the tax book for this year for an average Nigeria and for those who are in the informal sector? The folks feel they are paying so much tax. For those who are paying, there are a whole lot who are out. But again, you have the ordinary man on the streets who survive in Lagos, Kano, on Nature Main markets, in area markets, in Aba, elsewhere in Zaria, and all drinking carbonated and sweet drinks. So will they be impacted by President Buhari's new sugar tax law? Sorry.
Well, once there's an increase in cost of compliance or cost of running business, so the business try to see how much of that can be transferred to the final consumer, or how much of that can be taken over in its OPEX. The guess is that the manufacturers are probably going to try as much as possible to push a bit of that in terms of the price. So possibility of an increase in price for some of those carbonated drinks and sweetened consumables that folks on the street drinks. But I guess the reason why they're called sugar tax is that this is government saying it's not healthy for you, right? To consume product that can expose you to diabetes, or if you have an excess of that. That's why folks in other part of the world introduce it. We don't know whether it is right to say at the level that we are in Nigeria, whether there's any empirical evidence to say we've gotten to that point where we want to start penalizing. If you look at the health records and all of that. So, but overall, from the Finance Act, beyond some of those changes that business may want to pass on, there isn't any so much big changes from a personal income taxes that will increase tax burden on individual. If anything at all, it will be on those who are not compliant, because what government has done significantly, whether to individual, to corporates that are domestic player, or to large digital services player, is to actually strengthen enforcement with an expanded and a strengthened penalty regime. So sometimes some of the penalty that you will pay 10,000 naira, 100,000 naira now comes in their tens, and hundreds, of thousands. In fact, banks are now required to provide records of new accounts, for folks that open new bank accounts, and there are penalties, for banks that fails to do so. So increased exposure for everyone who is operating bank account, who is just moving from one account to the other as a way of hiding funds, because government wants to make sure that everyone that is eligible to pay tax is visible to the taxman. And it's so because we've seen how sweet tax money can be. If you look at the budget for 2022, 65% of the proposed revenue is coming from non-oil. Right, so government has seen how focus on non-oil tax revenue can yield results, and we can let go of our obsession with oil. As at November, for example, federal government has probably only achieved about 53% of its oil proceeds, of expected oil revenue. But from non-oil sources, we did about 18% above target. We did about 118.
In other words, President Buhari is using tax as a means of econometrics or economic management is working? Yes or no?
It's working gradually. It's working gradually. But we still have a far and long journey to travel. The total size of the economy is said to be, if you look at the headline and you look at the size of the GDP and you just take, say, 5% or 7.5% of that from a VAT and just try to work down the numbers to see how much are we making and what is potentially possible, you'll see a significant gap that we need to do. And that's why, for me, we need to focus on how can we, block, all of those leakages and wastages. How can we strengthen the system? How can we deploy technology? How can we consolidate and have few taxes to chase so that the effectiveness and the efficiency of the revenue authorities is enhanced? That's what we need to do.
The man on the street will argue with me and perhaps with you that we need to collect more taxes, or that we're bleeding in the petroleum industry, for example, or the oil and gas industry. We're bleeding in a few other big industries. That what we are doing right now with the FRS just is scratching the surface.
I will agree, absolutely. So whether it's from the petroleum sector, formal sector, informal sector, just look at the numbers. 6.4 trillion naira collection by FIRS is a good record when you compare it with about 5 trillion that we made in the prior year. But it's a far cry from what this economy should be doing if we are indeed the largest economy on the continent.
If you're talking about the economy of about $400 billion US, what do you think our tax target should be?
At the very minimum, we should be targeting 20 trillion in the short term.
Annually?
Annually. If annually, compare with the 6 trillion where we are. Do the math.
So we'll still have about 14 trillion.
The gap is significantly wide.
But is the economy working as to generate 20 trillion naira tax money? Yomi, tell me.
So a number of factors are responsible for how I can answer that. All right. So one is the economic viability itself. So we could have 400 billion US dollar economy, and we're like, look, how much of tax is ideal? How well are businesses doing? Where are the leakages coming from? Because you don't tax companies from a profit perspective on their headline. You tax them on their bottom line, on their net profit. So
yes.
How much goes into OPEX? For power, for security, for several other things that many other economies will handle at the government side. All right, so those factors are totally understood, and that's why sometimes when we quantify the total tax collection in the country, there are formal taxes, there are informal taxes, and there are also taxes that imply taxes that businesses pay because you have to sometimes make your road, you sometimes have to provide your security, sometimes have to pay more on power than many of the other businesses do. So there are some leakages going along that line, and if we fix this at the center, rather than allow each of the businesses to, do this thing on their own, which is completely inefficient and wasteful, we can save a lot, and the bottom line is much better, and government can tax more. Now, but beyond that, even in terms of the amount that businesses are making currently, the level of compliance is still significantly low. The compliance culture is not up to where it should be. And sometimes this is what governments see. So when we complain about too many taxes, when we complain about, the taxes have been raised, when we complain about the aggression of the revenue authority need to be curtailed, what governments see on the other side is how many entities are registered on the CAC portal, for example, and how many can the FRS man see. How many guys are doing large transactions with properties, and all of that, and how can we link the tax clearance certificate that these folks bring forward to the value of the transactions that they are doing. So the compliance level is still significantly low, and both there are levers that needs to be pulled almost simultaneously. We can't continue this blame game, right? So there's just this trust deficit. So the folks who are not paying taxes think they are justified because government isn't doing so much with what is collecting, and government on the other side is like, look, it's not yet time for reprieve because many of you are not yet doing what you're supposed to do. So
you're not paying taxes.
Absolutely.
So are we done with the luxury tax yet? For those who have, and I'm going to respectfully ask about this, what I would do, so I drink very highly exotic products, for example, whether are they alcoholic and cars and vehicles and what of that, or those who have private jets, for example. I'm not sure if you have one, but I'm just going to ask. But anyway.
Well, at this time, thankfully, in the Finance Act 2021, nothing, no changes as far as that is concerned.
No changes or nothing is going to happen?
Well, something can still happen in the course of the year, but as far as the Finance Act is concerned, as we speak now, nothing in that area exists. But of course, there are some aspects of our law that doesn't actually require, new laws being passed. Some just require expansion of some schedule, for example, and you get an executive approval.
If you are going to tax my bottle of soft drink, you've got to tax the man who is drinking this very imported bottle of cognac, whatever, that costs about 30, 50, 80,000 and 100,000 per bottle.
No, that's already been done. There's already an excise duty on alcoholic beverages. So unless those who are bringing them in are doing it, illegally, and they are not visible to the taxman, and that's part of the, the benefit of the consolidation that we're talking about. So when folks that are bringing in some of these items have to deal with customs separately, deals with FRS separately. There's a lot of hide and seek. That's why in Ghana it's only one GRA. In South Africa it's only one South Africa Revenue Service. In Kenya it's only Kenya Revenue Service, Kenya Revenue Authority. Yes. In the UK it's HRMC. But in Nigeria it's like 20 different agencies responsible for different kind of things. So I come to Bosin, I say a different kind of thing. I go to your cameraman, I say a different kind of thing, and that's how it goes.
I got it. It makes the rat get away.
Absolutely. Everybody thinks it's someone else's responsibility.
Let's have it here this time to just wrap it up. Thank you so much. And that's the man I call the tax oracle, Nigeria's tax ref. We're grateful for your time this evening, having you here. Yomi Olugbenro, partner and West Africa tax lead at Deloitte, Nigeria.